We begin with Chapter 5. In this chapter, we will analyze in detail the long call position. The long call position is used when the market outlook is bullish. The strategy consists of buying a call option. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contract, and besides, the values do not include brokerage commissions. The maximum profit on this strategy is unlimited because the increase in the stock price has no limit. On the other hand, the maximum loss that we are exposed to is limited. The most we can lose is equal to the premium paid multiplied by the number of shares. The break-even point is equal to the strike price of the option plus the premium paid. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a losing situation. For stock prices higher than the break-even point, we are in a profitable situation. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the cost of the call. This is the minimum amount of money that must be deposited into our account in order to place the trade. An increase in volatility helps the position. Time decay hurts the position. With respect to exit conditions, to close the position we must sell the call. If the stock price is higher than the break-even point, we are in a profitable position. Otherwise, we are in a losing situation. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at the time of call purchase. As we get closer to call expiration, the curve of profits and losses is like the one shown in green. And finally, at call expiration, the curve of profits and losses is the one shown in red. We can see that as time passes, the value of the break-even point increases. Notice how it moves to the right. And as the value of the break-even point increases, the range of prices for which we are in a losing situation increases. Therefore, in this case, time decay hurts the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the eBay company. As we can see, on August 19, 2011, the company gave us a clear bullish signal because the stock touched support, and this was accompanied by an increase in volume and an RSI below 30%. As we said, on Friday, August 19, 2011, eBay gave us a clear bullish signal. In order to take advantage of that, suppose at that time we had decided to buy call options. At the close of that day, eBay was trading at about $27, so we had bought 10 call option contracts with a strike price of $28 and expiration in September 2011. That is, we had bought 10 eBay September 2011 28 strike calls. The August options expired on that Friday, so it did not make sense to buy them. The premium of each contract was $1.3, so a single contract had a cost of $130. Remember that an option contract represents 100 shares. Thus, the 10 contracts would have cost us $1,300. With the 10 contracts, we would be in control of 1,000 shares. A few days later, the stock started to rise until it reached the price of $31 on August 30, touching the 15-day resistance. It is important to mention that when we choose the contracts to open a long call position, we must consider the following points: strike price, expiration date, and liquidity. With respect to the strike price, in general, the most appropriate choice is to buy the out-of-the-money option nearest the current stock price. Regarding the expiration date, that will depend on the horizon of investment. And regarding liquidity, it is recommended that the option has a spread, that is, a difference between the bid and ask prices, of less than 20 cents. In our case, the call options we bought were out of the money because their strike price was higher than the stock price. The strike price was $28 and the stock price was $27. As we had said, we bought the calls on August 19, the day we got the bullish signal, and a few days later on August 30, the stock reached the price of $31, touching the 15-day resistance. At that time, the premium of the contracts was $3.4, so the 10 contracts would be worth $3,400. If we had sold them at that time, we would have made a profit of $2.1 per share, because we had bought at 1.3. Thus, we would have had a total profit of $2,100, making a 162% return on investment in only 11 days. After August 30, the stock price fell for a few days, but then rose to a high of nearly $34 on Friday, September 16, the day of options expiration. At that time, the stock almost touched the 3-month resistance. That can be seen here. After August 30, the stock price fell for a few days, but then on the expiration day of the options, which was September 16, rose to a high of nearly $34, almost touching the 3-month resistance. At that time, the premium of the contracts was $5.7, so the 10 contracts would be worth $5,700. If we had sold them at that time, we would have made a profit of $4.4 per share, because we had bought at 1.3. Thus, we would have had a total profit of $4,400, making a 338% return on investment in only 28 days. Here we can see the numbers of our example. The strategy consisted of buying 10 eBay calls with a strike price of $28 and expiration in September 2011 at $1.3. Remember that the premium of an option contract is expressed per share. Therefore, our investment is equal to 1.3 multiplied by 100, which is the price of each contract, multiplied by 10, which is the number of contracts bought. That is a total of $1,300. This money is debited from our account. The initial margin required is equal to the 100% of the cost of the calls, that is, $1,300. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is unlimited, because the increase in the stock price has no limit. If we had sold at 5.7, we would have made a profit of $4,400. On the other hand, the maximum loss that we are exposed to is equal to $1,300, that is, the entire premium paid for the options. The break-even point is equal to the strike price plus the premium paid. In our case, 28 plus 1.3, which is equal to $29.3. Here we can see the order we must enter to open the position. It consists of buying 10 eBay calls with a strike price of $28 and expiration in September 2011. In the side column, we select the action Buy to indicate the purchase of options, and in the Position Effect column, we select the option To Open to indicate that we want to open a new position. The entered price is $1.3, and the order type is Limit. That is, we want to buy the options at a maximum price of $1.3. Remember that the premium of an option contract is expressed per share. In the Time in Force column, TIF, we select the option Day to indicate that we want the order to remain open only during the trading day. In the Instruction column, we select the specification All or None, AON, to indicate that we want the order to be executed only in its entirety and not partially. And in the Exchange column, we select the option Best to indicate that the routing of the order will be made automatically by the broker. Here is an example of the order we must enter to close the position. It consists of selling the 10 eBay calls that we had bought. In the Side column, we select the action Sell to indicate the sale of options, and in the Position Effect column, we select the option To Close to indicate that we want to close an existing position. The entered price is $5.7, and the order type is Limit. That is, we want to sell the options at a minimum price of $5.7. In the same way as for the order to open the position, in the Time in Force column, we select the option Day. In the Instruction column, we select the specification All or None, and in the Exchange column, we select the option Best. Here we ended with the chapter Long Call. In the next chapter, number 6, we will analyze in detail the short call position.